In this video, I'm going to show you how to make the journal entries for a byproduct when a company uses the production method. So let's get into an example. So we've got a company that produces one main product, lumber, and then they happen to have a byproduct, wood chips. So they're in the business of making lumber and they just happen to get some wood chips on the side. How much wood chips do they produce? Well, they produce 4,000 pounds, and they expect to sell it for $1 a pound, and they in fact sell 1,200 pounds for $1 a pound this period in December. But then we're going to assume that December 31st is the end of the fiscal period, and then in January they sell the remaining 2,800 pounds of wood chips. I'm going to show you how to account for all of this with journal entries, but long story short, with the production method, what we're going to do is we're going to say, look, we're expecting to sell these wood chips for $4,000. That's 4,000 pounds times $1 a pound. So we're going to reduce, according to the production method, we're going to reduce the total manufacturing costs of the lumber by $4,000 in the period in which this byproduct is produced. Let me show you how this all works. So I've got a series of events here on the right, and I'm going to walk you through, because I know it's a lot of information. So up front, we buy $150,000 of raw materials for cash. What are the raw materials? Well, they're trees. We're making lumber at this company, so we buy trees. We get $150,000 of raw materials inventory, and then we credit cash. Now, once we put those materials into production, and let's say all the raw materials are used as direct materials, we put all of it into production, we're going to credit the raw materials inventory account for $150 and then debit work in process inventory for $150. Then we incur some direct labor costs, so we debit work in process inventory again for $20,000. And then we have where we apply $80,000 in manufacturing overhead, and this is applied overhead, not actual, so we're going to debit work in process inventory again. So if we got a T account here for our work in process inventory, we're at $150,000, and then we add $20,000. I'm just assuming the beginning balance was 0 to make it easier, and then we add $80,000. So we're up to $250,000 in the work in process inventory account. Now, let's assume that all those goods are finished in December. It's no longer a work in process, it's finished goods. So because we have here $250,000 of work in process, we're going to have to credit it. We're going to credit work in process for $250,000. So we're credit work in process. Now, you might think, well, we would debit finished goods inventory of lumber for $250, but we do not. We debit it, but for $246,000. Why that amount? Well, we take the $250,000 and we subtract the expected selling price of the byproduct, $4,000. Okay, so we subtract that. Some companies will subtract the net realizable value, but I don't want to get too complicated here. Let's just assume that they're just deducting the expected selling value. Okay, so $250,000. That's the manufacturing cost of the wood chips so far, but we're going to subtract out the expected selling price of the wood chips. So how do we account for that $4,000? Because we can't debit $246 and credit $250. The debits and credits wouldn't equal. So we debit byproduct inventory for the wood chips for $4,000 to make this account balance. So now we have $4,000 of wood chips in our inventory. Now let's say on December 19th, we sell all of the lumber. Okay, so all the lumber is sold. So it had been $246,000 in finished goods, but now we're going to zero that out. So we have finished goods here of $246. We're going to credit finished goods inventory lumber for $246,000, and we're going to debit cost of goods sold for $246. So you see the practical effect of reducing when we took the expected selling value of the byproduct and we reduce the total manufacturing cost. Ultimately, that manifests itself in lower cost of goods sold. That's how that plays out in terms of the effect on the income statement of this byproduct under the production method. Now, assume later we sell all the lumber, so we credit, we got revenue for lumber, and then we got accounts receivable and so forth. What happens when we sell the wood chips? You might be wondering, because we had said in the beginning, I don't know if you remember, but we sell 1,200 pounds of the wood chips in December, and our selling price was $1 a pound. So what we're going to do, we got to credit this byproduct inventory for $1,200 to reduce it, because those wood chips are no longer in the inventory, and we're going to debit accounts receivable, which seems weird because normally when you debit accounts receivable, you credit a revenue account. but we don't do that under the production method. We're debiting account receivable, and then we're crediting the byproduct inventory for wood chips. Now, after fiscal year end, so December 31st, I said was fiscal year end. So now in January, we sell the remaining wood chips, and we sell, so it's 2,800 pounds at $1 a pound. So now we debit accounts receivable for 2,800, and we credit byproduct inventory for 2,800. So now the byproduct inventory is at zero because we started at 4,000, then we credit for 1,200 and credit for 2,800. Now, again, if you're confused, if you're saying, wait a minute, I don't understand, how does this affect the company's profit ever? Because when we're debiting account receivable, we're crediting this byproduct inventory and not revenue. Well, remember, when we made the byproduct, we reduced the manufacturing cost of the lumber. So this is $246 instead of $250. And so then when we sold the lumber, our main product, when we credited the finished goods for $246, we debited cost of goods sold for $246 instead of for $250. Okay, so this basically, the production method is reducing the manufacturing cost. And how does that affect the income statement? Because the manufacturing costs ultimately flow through the income statement and are expensed through cost of goods sold.